Hi, this is Chris Conroy, EVP of National Accounts with Insurance Agency Marketing Services, or IAMS, and I'm pleased to be hosting today's third webinar program in our five-part series, Elevate Your Sales EQ, which we know you'll find to be a highly engaging conversation with nationally recognized expert on client financial psychology, Dr. Jack Marrion. And we will provide you with some tangible takeaways that you can incorporate in your practice immediately. IAMS has a deep-rooted commitment through its 34 years in business to delivering on one simple promise to our customers: to help you win by providing you the tools and advice so that you can thrive. We're committed to winning your trust through industry excellence and leadership. This Elevate Your Sales EQ series will deliver on that promise, a promise that will help make you a better financial professional in your relationships with your clients. And that's why when we talk with some of our top advisors here, how we could up their sales game, especially with the challenges faced by COVID-19, we focused our attention on how you can better connect with your clients on an emotional level by increasing your emotional quotient. Because we know it's one thing to have the highest IQ in the room, but that doesn't close sales. Having a higher sales EQ matters more. The ability to connect with your clients through empathy, understanding your own emotions, and communicating in ways that make sense to them. That's why upping your emotional quotient is so important. We held our first and second parts of this series over the last 2 months, and we had a record level of participants, many of whom have registered for today's program as well. For today's third installment of our Elevating Your Sales EQ series, we will cover fixed index annuity crediting methods. Before I introduce our featured presenter today, I'd like to take a minute to thank North American Company for Life and Health Insurance, whose generous sponsorship helped make this webinar series possible. We've been pleased to partner with North American Sales VP Tia Stanley to create this webinar series. Her broad experience and skills in the annuity industry at both a leading distribution firm and with top carriers has made her a well-recognized sales leader. I also want to share our appreciation for the industry research and leadership that North American has shown in its top producer survey called Project Apex, which helped identify key attributes and behaviors of top performing producers in the fixed annuity industry. T and I held a webinar program on Project Apex last month. I'd encourage you to reach out to your marketer here at IAMS for more information on that survey, its findings, and how we can leverage those insights to grow your own practices. And now I'm pleased to introduce our annuity think tank expert, Dr. Jack Marrion, as our featured presenter today. Let me share a little background on his work. Jack's been a top industry and written academic books and publications, including Indexed Annuities, A Suitable Approach, Gen X, Gen Y, and Fixed Annuities, Real World Indexed Annuity Returns with the Wharton Business School Professor David Babel. He's also done research studies through his Advantage Compendium. He's been an expert witness for NAIC comments and also the 2016 DOL fiduciary rule combined litigation effort, which ultimately led to that rule's defeat in the Fifth Circuit Court of Appeals. He's been a past president of a broker-dealer, a past officer of life carriers, past officer of an investment banking firm. He's also led academic research in how annuity clients think and what their internal biases are, with a doctorate from Webster University on behavioral biases, where he's been a research fellow. Last, Jack's won the NAFA Bo Johnson's Lifetime Achievement Spirit Award, recognizing his many years of contribution to the fixed annuity industry. Jack, welcome to the program.
Thanks, Chris.
Well, today's format will be relatively straightforward. For those that have been on the other programs, you're familiar with this, but Jack will lead us through this presentation, and I'll pose a few questions and observations along the way. I'll also be offering to everyone on this program several polling questions to help make this interactive so that you can see how other advisors are also thinking. Be on the lookout for those polling questions throughout the program. Please answer them, and then I'll share the collective responses along the way. If you do have a specific question that you'd like to ask, you can go ahead and do that in the chat box, and we'll get back to you as soon as possible after the program. Well, with that, Jack, let's get into today's topic: crediting methods on fixed indexed annuities. Jack, we've certainly seen a lot of changes and developments in crediting methods, volatility control indices, other kinds of parameterization on the FIA crediting engine. Has this all been a good development to kick things off?
Generally, yes. Yeah, most of it has been good, but it's gotten so involved and so complex that this webinar goes back to Index Annuities 101 and goes from the weeds up to the mountaintop. So with that, we should probably get started. When you get in $1 of premium, the insurance company gets in $1 of premium, the net dollar is invested in the general account, typically in bonds, and the bonds earn a return. In this environment, the net return would be around 2%. If it's a fixed rate annuity, the carrier credits 2% interest for the next year on that annuity. If it's a fixed index annuity, they use that 2% to buy a link to an index, and that link is typically a call option. Historically, it's been a call option. This is an actual pricing schedule to buy $1 of the S&P 500 at one point back in time. I don't remember exactly when. What it says is, if you had 9 cents, you could have bought the index at today's value at the end of the year, $1 worth of it. If you had 13 cents, you could buy the index at today's value 2 years from now. And 3 years from now, it would cost you 17 cents, and so on and so on. What this shows is the longer the option is good for, the more it costs, because the risk of the index going up increases over time. Now, if you had 9 cents, you could buy all of the option and have 100% participation rate in the index. However, we don't have 9 cents because we're not earning 9% net. We're earning about 2%. We have 2 cents. So what we could buy in this environment is 22% of that total option, which is just 2 divided by 9. That's your participation rate, and that's how participation rates are set. What this does show is how it answers the question, what happens to the rest of the gain? What happens to that other 78%? Well, it doesn't go to the insurance company. They never had it. It remained with the option seller. Now, we have a 22% participation rate on an annual point-to-point measuring from the start to the end of the year, but that can be expressed in different ways. For example, if you average the values over the days or the months of a year and use that average total as your endpoint, you find out you're getting 55% of the index gain. That's averaged out over time. Averaging produces 55% of the gain of the unaveraged index. What that means is over time, a 40% participation rate using averaging produces the same return as a 22% participation rate that's not averaged. You can also apply caps and do the same calculations. A 5% cap with an annual point-to-point, a 7% cap with daily averaging. Over time, it gets you the same average return as the unaveraged 22% or the unaveraged 40%.
Yeah, Jack, I just interject. I think you're right. Two cents on a dollar is probably about what many carriers today on, say, 10-year FIA pricing chassis will use. Maybe it's 1.75, maybe it's 2.25. That's probably a pretty good proxy. And I think you made an excellent point. I think that's something we even hear from producers today, which is, well, the carrier must be making, keeping the extra money, so to speak. That's above the level set, and that's just not true. The carrier is just buying that portion that would match the liability that they're providing, that they'd have to pay off to the consumer ultimately if in this case the S&P went up.
Exactly, and they're all priced to come out about the same because you don't want the carrier having one crediting method that's much better than the others. Everybody would flock to that one method. And I threw in there the trigger method, also called the binary method. And that's the method where if the index does not go down, you get a stated rate. And in this example, a 3% trigger produces the same return as all of the others over time. Again, in any one year, any of these indexes can be best. But over time, the answer to the age-old question, which crediting method is best, is yes. Depends what you're comfortable with. What drives the participation rate? Two factors: interest rates and option prices. If we have higher option prices, often caused or reflecting higher volatility, you can buy less of the option. We have 9 cents is the cost of the option. We have 2 cents to buy it. If the option cost was 6 cents, we could buy 33% of that option. By the same token, with interest rates, if we had higher interest rates, so we had a net of 3 cents, we could now buy 33% of that 9% option. So interest rates and option prices are what affects index participation. And the big slammer this year has been falling interest rates. There's less money available to buy the participation.
Yeah, the other thing too, as you mentioned, is volatility. So the implied volatility with, say, the S&P 500, which is on most of the FIAs as an option today, higher the volatility, does that make the call option price relatively more expensive, Jack?
Typically, yes, because it increases the risk that you're going to get caught in a day when the index is up.
We'll talk a little bit, on volatility control later, and maybe that helps dampen some of that from the crediting engine. Well, let's move on to that next slide then.
Okay. What the bottom line is, we're talking about options and hedging and all that stuff, which can be scary. But you have to remember that the annuity owner is not buying any of this. They're buying a fixed annuity with a minimum guarantee. And the insurance company's protected because they're buying a right to buy something, not an obligation. You could buy a stock at 50 bucks a share. If it drops down to 30, you lost 20 bucks. But if you buy a call option that gives you the right to buy it at 50 bucks, and the call option costs $2, doesn't matter how far the price of the stock falls, the most you're out is $2. So the index annuity is also protected. What it comes down to, as the next slide shows, is the real issue here is the risk here is that the annuity will not perform as well as something else might have over the same time period, which is the risk with everything.
This is where I might interject, Jack. I know we've had a lot of our advisors who contact us, and they compare fixed annuities, declared rate annuities, fixed index annuities with things like CDs and and bonds. And so I'll launch a couple polling questions here. If somebody's interested in either our FIA as a greater, as a better bond alternative, or right now we're upcoming now to October, which is historically CD replacement month along with April. So if you are interested in our IAMS CD replacement kit, which includes a lot of client-friendly materials, explanations, kind of talking points and so forth, go ahead and answer yes there, but that's on our CD replacement kit that we've had a lot of advisors ask for. It's certainly very helpful. And in today's marketplace where, CDs are maybe paying 1%, at the bank, maybe a little bit higher online, that's a good opportunity, I think, to take a look at where do fixed index and also fixed annuities MYGAs fit. So if you're interested in that, go ahead and answer yes, and we'll close that poll up here and move on to the next slide. Jack?
And this is a very powerful slide. It sounds simple. Annual reset, fixed index annuities reset annually. I mean, that's simple, but that's so powerful. Because what you can have is a situation where the index starts at 1,000, is at 800 a year from now, and at 900 2 years from now. So the index is still underwater. But because the index annuity resets its starting point at the end of the previous year, you're participating in a 12.5% gain. So even in a bad market, the annual reset strategy can produce a return. And the next slide hopefully drives home just how powerful this is. And you can use any 50-year period. I didn't cherry pick it. This is just it. If you put $10,000 into treasury bills, it would have turned into 106,000 bucks. If you could have found 50 years ago an index fund and had all those reinvested dividends, even though there wasn't such a thing back in '68, it would have grown to 1.1 million. But if you take the same 10,000, do not include reinvested dividends, but take an annual reset approach, that $10,000 turns into $2 million. That's the power of annual reset.
Yeah, that was, I know, Jack, you and I were chatting about this. I almost thought it was too good to be true, but because I think that's a criticism you hear, especially in the broad-based media as well. You know, with these products, you're not getting dividends. You would have thrown that in. You actually would have done better. But you know, this is not cherry-picked years. You could pick different time periods and find the same result, almost twice as good of a result with an S&P 500, the reset versus just going directly into the S&P 500 with dividends.
Yeah. And the real key point on this is we're not really trying to beat the stock market. We're trying to beat the T-bill. So it's even more, it's stronger. The annual reset effect works best in choppy markets. If you had a market that's steadily going up, it doesn't get you much of an advantage. In the 90s, you didn't get a great advantage from annual reset because the market was steadily going up. In the previous decade, an annual reset didn't buy you much. The annual reset method over the last decade, you produced a gain of 154%. If you just look at the S&P 500, you were up 151%. So if you believe the market is just going to steadily go up, you don't need an annual reset. But sometimes the market does not do that. And then it comes down to which method do you pick? And that's usually a yes, but there are times when it's not a yes. I've compared here a 22% participation rate and a 4.5% cap. What you find at these levels is the 4.5% cap has a lot more years where it produces interest and more interest than the 22% participation rate. In the current market, the way participation rates are and the way caps are a better story. But that's not always true. As the next slide shows, there are times when participation rates are the better story. Today, you can find a 4% cap, and it'd be very tough to find a 28% participation rate. A couple of years ago, you could find 45, 50% participation rates, but it was hard pressed to find 7 and 8% caps. So there are times when the pricing is a little different and you can find what you like, either a cap or a participation rate. But it still comes down to which you're more comfortable with, because over time, these are priced to perform the same. However, today, the cap is the better story.
That's where I might interject, Jack. I'm going to launch a poll question just to get the audience reaction. You know, today, in today's environment, are advisors typically recommending more of a par rate or a cap rate? So I'll collect that and share those responses. And as you say, I mean, we've seen historically, even some of last year, where FIA carriers were offering as much as a 50% par rate, which is a nice milestone, you know, number, because it's easy to explain, I think, to consumers. Is say you get half the S&P 500. It's a little more complicated when you say you get 37.2 or some kind of, you know, odd number. So milestone numbers sometimes matter. But we're also environments where you know, cap rates make more sense. They're easier to make sense of for the consumer, and particularly an environment where there's just not a lot of yield out there, you know, on equal investments such as bonds. So I'm collecting those responses here. I'm going to close that poll and then share the results. So it looks like well, about half are selecting more par and half more cap. So that's pretty balanced. I don't know that that's, I think historically you probably, maybe if you went back to 18 and 19, you would have seen a little more par rate given some of the products that were out there. And maybe that's been a shift to more of a balance between both par and cap today. Let's move on to the next slide then.
Okay. Another question then, if you're talking about cap versus par, is you go with a MYGA versus a cap. And looking at 5-year MYGA rates, this tries to compare those with what FIA cap would be needed to equal the same return. Now, of course, if you had a 2.5% MYGA rate and you had a 2.5% cap and the index performed at least 2.5% each year for 5 years, That would be equal. Typically, in more times than not, you have one negative year. You have 1 year of zeros out of the 5. And in that environment, you need about a 3% cap to do better than a 2.5% MYGA. If you have a 275 MYGA, you'd need better than a roughly 3.5% cap to outperform that. In today's environment, historically, the caps are still outdistancing most of the MYGAs. So it still makes sense to do the cap because you will get a better return than you would get on the MYGA, historically speaking. However,
yep. And that's just interjecting, Jack. I mean, today, yeah, there's probably couple carriers that might offer a 3% MYGA today. FIAs generally are sold, on 10-year product line, and commission's a little different between the two, I think, as everybody knows. So there are some differences, but this is another one where I know you've done a great job illustrating that in more detail in the white paper that's collateral for today's program. So for those on the call who didn't get it, or you're more interested to talk about that, reach out to your IMS marketer. We can get you the white paper where there's a lot more detail about those trade-offs between MYGAs and FIAs.
And this just points out that some of the times you have 2 years of negatives. Thank goodness that's less often than 1 year. And you need much higher caps. 2.5% MYGA needs a 4.2% cap. This shows a couple of things. If you're very pessimistic about the future, or your client's very pessimistic about the future, the MYGA probably makes more sense. However, they're not going to get skunked if they have a 3.36 cap and still have 2 years of losses. They would do as well as they would have done in a 2% MYGA. So that's kind of your cases and your range. How do they do versus taxable bond funds? These are actual returns. I've been collecting actual returns from carriers and taxable bond funds for a long time. In the preceding 10 years, the taxable bond funds did pretty well over 5-year periods because you had 3 0 years during the millennium bear market combined with rapidly falling interest rates. And when rates fall on an existing bond, the value of the bond goes up. So taxable bond funds did very well in the previous decade. If you look in this decade, we basically hit bottom on rates. It's hard to fall anymore. So what we're seeing is, even in a lower interest rate environment with lower caps than we had back a decade ago, the index annuities produce better returns, or at least competitive returns, with taxable bond funds. The takeaway is, looking at where we are right now, is index annuities should still be able to offer competitive returns with taxable bond funds.
And this is where I'll launch another poll question about if you're interested in our IAM's own FIAs, a better bond alternative, then I encourage you to reach out and respond to this question and talk to your marketer. But we do have a great white paper that talks about FIAs, a better bond alternative. We use some of your research, Jack, in compiling that, and some work from Roger Ibbotson as well, and some of our own research findings that ultimately these products have historically done very well against bond funds, and today more than ever, given, and I don't know, A-rated bond funds might be 2%, somewhere in that order. FIAs, which offer, a nice guarantee and other bells and whistles like guaranteed lifetime income, certainly a great thing. So if you're interested in that piece, then go ahead and respond yes. With that, I'll close it and move on.
And we'll wrap up the section on traditional indexes. The typical traditional indexes used in this area are the S&P 500, the Dow, the NASDAQ, and the Russell 2000. And this has a similar story to the other story about with a yes answer. If you look over time, and this shows the last 15 years, the indexes correlate. They tend to move together. Now, there are no negatives on this because with an index annuity, you can't get a loss. So the worst you can get is a 0 return. What this really shows is, if you're talking a cap, you want to go with the highest cap. Doesn't matter what index it is, you go with the highest cap. That should be the best choice. If you're talking a participation rate, it gets a little dicier because The NASDAQ has outperformed the other indexes over time. The Russell 2000 has slightly underperformed the other indexes over time. So you could accept a lower participation rate on the NASDAQ and a higher participation rate on the Russell 2000 to equalize it all out. But it still really comes down to a choice of what you like. So index, pick the highest participation rate, pick the highest cap. It's all preference. And if you haven't looked at the trigger, the binary strategy, take a look. It's a very simple explanation, and it's performed well over time. And the most important thing is, regardless of what method you pick, how the carrier treats you at renewal is more important than the method itself. And to gain insight like that, you should talk to your IMO.
Give us a call. Yeah, that's a tough one. That's a question we get a lot, Jack, is, hey, these rates seem great, but what's going to happen in a year? And, and there are limits. Obviously, take a look at the contract minimums and maximums that can be provided on renewal. But renewal rate history is a tough one. Some carriers have published it. A couple still do today. Many do not anymore. And so I think the only way you really know is it's a bit of a trust me. And I'd encourage you to reach out to your marketers here, and our average tenure is 10 to 12 years, our marketers. So you're going to get a good answer about which carriers can you kind of count on, the ones that have been in the history, who have enough history to be able to talk about what the renewal parameters have been.
And now we start getting into volatility control, the newer days. Carriers have always been trying to control volatility because, as Chris mentioned, that has a big effect on your option prices, on your hedging. The higher the cost, the less participation you can get. Now, from the second method ever used, carriers tried to control that volatility. Second method used a cap. The third method used averaging. The binary method came out in 2000. The monthly cap came out in 2004, monthly point to point. The rainbow briefly appeared in 2008, and then the sunset by 2010. And then controlled volatility indexes came up after that. They've all been an attempt to control volatility. Controlled volatility indexes try to limit the volatility, and that can result in higher interest rates. There are over 5 dozen volatility control indexes used in this space. There are more indices that talk about volatility, but are not volatility controlled indexes. They just use the same terminology, and that's a biggie. A volatility controlled index has a target, and that's what makes it a vol control index. And I have my teeter-totter. It kind of illustrates that. When it goes above the target number, money moves out of the equity side, the high volatility side, and into cash, where it earns little or nothing. That's when the teeter-totter is rising. When you have a falling teeter-totter, when you're below that volatility target, money moves back from cash into equities. And you earn the money from the stock market returns. So what you have at the end of the year is money you made from the equities and money you made from the cash. And as the next slide shows, together they provide the total index return. So the concept in a way is simple. You have a trigger, you move the money back and forth, you have a stated target rate, it's stated right in the index, can't be changed, and together that produces your interest. Now, an issue I have that I won't rant about as much as I usually do is, over the last 12 years, volatility's taken on a whole different meaning in Wall Street. Wall Street tends to use volatility as a synonym for loss. They'll talk about managing volatility, controlling volatility, limiting volatility, and what they're trying to say is this will reduce loss. But volatility and losses are two entirely different things, and you don't want to confuse the two. So I shortened up my rant.
Yeah, Jack, it's it is interesting. I would expect that, we were talking earlier about what do we see? What's the next iteration of volatility control? And I would expect to continue to see more and more indices with different forms, and we start to see artificial intelligence based ones. Other iterations of that, I think, are in vogue and will continue. A lot of what we've seen, frankly, in the investment world on variable annuities will probably make its way over to the FIA side.
Yeah, the whole concept is interesting. If you look at what this chart does, is shows the effects of controlling for volatility, and the VIX, the VIX, CBOE's VIX, use all the initials in the world, uh, is the future pricing mechanism on the S&P 500 for volatility. Volatility historically on the VIX is 18 to 22. So what this chart does over this 20-year period is it took money out of the S&P 500 and moved it into cash every time the VIX went over 22, and then put it back into the market when the VIX dropped below 22. And that's shown by the green. And as you can see, by doing that, we missed most of the losses of the millennium bear market and the crash of 08. So controlling for volatility did prevent these losses. However, it also prevented some gain. If you look at the average long-term return controlling for volatility, you wind up with a 9% annualized return. If you ignore the volatility and just look at the stock market without any control, you wind up with a 9% return. Huh. So why are we doing volatility control indexes? Because they provide the potential in the fixed index annuity space for more interest than traditional methods.
Yeah, the other part of that too, Jack, just from a consumer perspective is, I mean, would it be fair to say with a volatility control index, all those things being equal, you're more likely to hit some singles and maybe a few doubles than have less strikeouts and less home runs?
With the vol control, you're more likely to have a home run, which is kind of the difference. You'll get more singles and doubles, but more possible home runs. The big thing about the control volatility area, and again, over 60 of these things out there, 20 years ago, a regulator looked at the half dozen methods out there and said index annuities are like snowflakes, no two are alike. Wow, he had never seen control volatility indexes, because there are a lot of different factors that affect how the index works and the final number that is credited to the consumer. These are some of the major factors, and I'm going to touch on everything but leverage. And all that means is you can borrow money on some of the indexes. So let's get started with servicing costs. Servicing cost is an index fee. It's the fee charged by the index for using the index, and it ranges anywhere from 0.25% to 1%. Now, the fee is listed, and it's legitimate, it's there, but you need to be aware of how it impacts returns. For example, like in the next slide, you've got annuity A, which has a 2% yield spread. Annuity B has a 1.5% spread. Based just on that knowledge, you choose annuity B because it has the lower spread if the annuities were identical. But what if annuity B has a 1% servicing fee? Well, then off the gross index gain, you're taking 2.5%, which is higher than the 2% spread on annuity A. So when you get down to the bottom line on this, for the next slide, sorry, you earned more money with a bigger spread because you did not have the servicing fee. So that's a servicing fee or index fee. You need to be aware of that.
Is that, Jack, in your
Yeah.
experience, is typically explicit? That's something that producer can find out about. Is there a right to change that fee during the term of the contract?
I don't know the answer to that. I don't know. I know it's usually in the footnotes, but I don't know the answer to that.
Yeah, I think in our experience, typically what we've seen, it's a fixed fee, or there's a maximum stated number. But that's again a good question. I think producers to ask. Talk to your IMS marketer here. We can get you the answer on any specific product and how those indexes work. So uh, that's probably a question that a lot of people should ask but don't ask, because ultimately that's affecting what their clients earning on their crediting engine. Let's move on to the next slide then about excess returns.
Okay. What an excess return method does is it subtracts a benchmark rate, which is typically the Fed funds rate, can be T-bills, can be a 3-month LIBOR rate. Now, if these benchmark rates are very low, they have negligible effect on the overall return. Today, you're talking about very low Fed funds rates. And if you're deducting 10 basis points or 15, 20 basis points from the gross return, that's not a real big haircut for the consumer. However, there have been times when some of these benchmarks have been as high as 2%. And the next slide kind of illustrates what you could run into. You've got annuity A, again, there's no service fee, there's no excess return fee. The index is up 6%, the consumer gets 4%, versus annuity B, where they've got a spread, they've got the fee, service fee, and they've got excess return, and the excess return is 2% on this example. You're only earning 1.5%. Again, same index, same movement, same gain, but a huge difference in what the consumer gets.
Let's take a look at volatility targets now.
And that's good because it's misleading for a lot of folks. The vol target is important only to the extent that it has one. The actual number doesn't matter a heck of a lot. You could have utility stocks in one index, tech stocks in the other. You could have a 10% vol target on the utility stocks, get 100% participation, and a much smaller target and participation rate in the tech stocks. But because the utility stocks just don't jump around much, you could wind up with a much lower return than the tech stocks, even though you're only getting half of the performance. So the vol target number is only important when two indices are exactly identical in all their parts, and they almost never are exactly identical.
Yep, and good point. I mean, give us a call. I mean, and there are some of these indices that are, on top. Take the S&P 500. Low vol control might be an engine that's on several different carriers' products, but you need to know what else is embedded in there by way of fees and the right of the carrier to make changes. So give us a call. We can help navigate you through that.
And on top of all these factors are strategies, and there are a lot of different strategies being used. These are four of the most common ones. And of all of them, the most common strategy is the low volatility strategy, which has nothing at all to do with matching for volatility. What it simply says is you replace the high volatility stocks in the index with low volatility stocks on a daily or weekly or monthly basis, however it's set up. But that has nothing to do with volatility control. So a lot of different factors are at play.
As I mentioned, we're starting to see some other even new strategies in vol control, artificial intelligence based and even what look like managed indices. So expect to see more in this space of development. And let's move on. What about the returns? I know we've talked about a lot of moving parts here today, Jack, but have these performed well?
The answer is yes, or yes, but there are two slides in all of this that for me really stand out. One is the annual reset over time, that $10,000 to $2 million. I mean, that's powerful. That's the annual reset story. The other slide that I think is very powerful is this one. This shows the return of all of the different vol control indexes used in the fixed index annuity space for a year ending August 1st of this year. So these are all calculating the gross gain before spreads over the same identical 1-year period, and you can see the range of returns. I mean, it's huge. Now, on average, you did pretty well. The average up around for these indexes was 5, 6, 7%, which is very good and proves they are competitive in general, and the theory works with traditional indexes. But again, look at the range of returns for all of the vol control indexes. It's huge. They are
And
like
that's,
Snowflake. Yeah.
I was going to say, I'll pause there and launch another poll question. I know we've talked a lot about volatility control indices on FIAs, and launch a question here. Just how often do other people, we got a big group on the webinar today, but I want to curious to see reaction from the field is how often do you recommend volatility control indices on FIAs? There's some people that don't at all, some that do all the time, and I suspect we got a good blend in the middle. Certainly been greater adoption of VCIs on FIAs. Jack, I don't know if you have to top of your head, but what percent is allocated to VCIs on FIA sales per year? I would guess at least 50%.
I don't have hard numbers. I know it's strong.
Mm-hmm. Well, I'm going to close up the poll here and share those results. It looks like, we do have a segment, 21% that never do. And then, around 70% would be sometimes or regularly. So that's pretty reflective of the industry total results, I think. Certainly have people that are not comfortable recommending it, but that's a small group of the total. Well, let's move on then to the next slide, and I'll have another polling question after this.
The key point on all this is for a traditional index, you can plug in the numbers, use the historical numbers. What you see is pretty much what you get. If you have the S&P 500 and have a cap or a spread, you know what you're getting. And you can compare two indexes or two products using the same index. With control vol indexes, it's tough to compare because you can't use the spreads, you can't use the participation rates, you can't use the volatility target rates, you can't really look at the assets, and you can't look at hypothetical returns, which is my next slide rant.
This is where, Jack, I was going to say, it is hard to compare. We're privileged here as a NAFA member to have access to your research. Jack is the Director of Research for NAFA, National Association for Fixed Annuities, and we have access to Jack's work he does to create the monthly Volatility Control Indices Performance Report, which shows how have these done on a year-to-date basis, how have they done on a trailing 12 months basis. So there's a great report that can show you of all those indices that are out there, how have they done recently. We don't have a actual performance over a long time period. We have a lot of backcasted numbers of what if, and we stitch things together to arrive at maybe what we would have done had we had those constituent parts. But we're starting to develop real track record history with these. And so if you'd like access to that monthly report, we can just answer yes. I'm happy to get that to you. With that, I'll close that poll.
And this is my second rant of the day. Many of the indexes that use in the vol control space have histories in months, not years. And they use very specific and short backtesting periods. I don't believe in using backtesting on vol control indexes. What Chris just mentioned, what I provide are actual returns. That's the only thing in the study are actual returns. So the takeaway here is I don't use backtesting, don't use the numbers.
Well, another quote I like, Jack, to interject here is, Warren Buffett is attributed to have said, rule number one, never lose money. Rule number two, don't forget rule number one. So it's funny because I think a lot of people say, oh, that's, the quote for FIAs, you never want to lose money. I think he's actually talking about is don't take actual realized losses versus just principal protected products. Now we like that story for FIAs because zero is pretty powerful, but it's also a thing about timing, and somebody who thinks they can time the market is usually a fool.
And what it comes down to on this is you can't really use a quantitative approach. You can't approach this from a numbers point and bring out the slide rule. It's a qualitative thing. It's, do you understand the concept? Can you tell the client the concept? And do you trust that the carrier picked a good index? Because it really does come down to a trust issue. And that's a little more, you've got to be able to explain the concept to the consumer. It's kind of nice if they know what's going on. But it's a trust issue. Now, having said that, these things are legitimate. Vol control indexes offer the potential for more interest, especially in a low interest rate environment. Vol control indexes have produced significantly more interest than other traditional methods over the last several years since they've been introduced. These things are for real. Even though they don't have caps, many of them, that doesn't mean the returns are unlimited, because that target volatility kind of poses an upper limit on what they're going to make. But we have seen many vol control indexes deliver double-digit credited interest on the index annuities. So to wrap this up, there's a lack of an actual track record, but the concept works. Trust the carrier and be assured that these things are legitimate. They do work. There's going to be more of them, and they're a part of the fixed index annuity world.
With that, Jack, I'm going to do a quick plug for our free market analysis report. So many of you know that we're in the business of being a collaborative sales partner to help you grow your business. And we have an outstanding creative team that will partner with you to make sure your marketing plan, your marketing budget is aligned with what your goals are if you want to grow. So we're pleased to work with thousands of producers around the country. And if you would like a free review of your marketing assets, digital and otherwise, to see if they're aligned and if we can help you, go ahead and answer yes. Something we've done with many of our top producers around the country. We're happy to reach out to you and get you your free market analysis report. So go ahead and answer there, and we'll wrap things up pretty soon. Well, with that, Jack, I just want to thank you for your look into an extra review of the crediting methods with FIAs, and thanks again to North American Company for their sponsorship. I'm certain that all of our attendees today picked up some nuggets that you'll be able to take back into your practice and implement into your business right away so that you can grow your sales and reach your fullest potential. I'd encourage you all to reach out here to your IAMS marketer at the company. It's 800-255-5055, and ask about 3 free items that we are offering all the people who have registered for the Elevate Your Sales EQ series. One, Dr. Marrion's white paper for this topic today. Second, our IAMS proprietary point of sale piece on the true cost of asset loss and the value of annual reset products. Great piece you can take in front of a client. And then third is that free customized market analysis report. See if your advertising is aligned with your target demographic and make sure you're connecting with them. Be on the lookout for the next month's program of the Elevate Your Sales EQ series, our 4th installment with Dr. Marrion. You won't want to miss it. Thank you for your time and thank you for your partnership. Thank you, Dr. Marrion.
Thank you.